Good morning, everyone. I'm Ben Mohr, and I head fixed income here at Marquette. Thank you very much for coming here, and I'm very excited, thrilled to share with you some of the research that we're doing in fixed income at Marquette. I am sure many of us here in this room have read this past year articles about the growing bond illiquidity problem. What we're going to do during my presentation is to go through a little bit of an in-depth look at this problem, its implications and how it affects our portfolios, as well as what the industry, the investment industry, is doing in terms of coming up with solutions for this problem, and what are next steps for institutional investors. So let's start by taking a look at some of the key numbers. From 2008 to 2015, U.S. banks' holdings of trading assets have declined by 40%. Global broker-dealer inventories of corporate bonds have declined by 80%. European corporate bond trading volumes have declined by 45%. Now, one of my favorite summer blockbusters this year has been a movie called San Andreas. It's about a seismologist who comes up with a model that can predict earthquakes. I was born and raised on the West Coast, and so the subject of earthquakes is really near and dear to my heart. I really think we're close to a next big one. I think it's long overdue. So we're going to see a lot of these screenshots of the movie throughout the presentation. When I look at the earthquakes and when I look at the next financial crisis, I see a lot of similarities. Here at Marquette, while we don't have a model that can predict the exact time or magnitude of the next financial crisis, we do have a series of barometers, key indicators that can tell us how severe or when it's going to happen and how the illiquidity problem is going to affect that. So let's take a look at how this problem developed over time. In the red, we have corporate bonds outstanding in the entire world. It's grown and doubled from 2001 to where we are now, and that's using the left axis. In the black dotted line, we have broker-dealer inventories of corporate bonds. These are the Morgan Stanleys, Goldman Sachs of the world that hold inventories of corporate bonds that trade with investment managers. Since 2008, it's drastically dropped, now to about 20% of what it used to be, and creating a liquidity gap. So we're going to take a look at how this liquidity gap affects us. Part of the reason we had this happening was because of financial re-regulation post-crisis, as well as a lot of investment banks like Bear Stearns and Lehman Brothers, I'm sure many of us have heard of, that have dropped from the landscape. So we're going to take a look at how this liquidity gap will affect our portfolios and how close we are to that next market correction. I've got two slides coming up that'll show those barometers that I've been talking about. So at Marquette, each month we have an investment committee meeting where we track a lot of key numbers from all the different asset classes. Within fixed income, we cover what we call key credit cycle barometer indicators. The best are high yield use of proceeds, high yield aggressive issuance, bank loan use of proceeds, and bank loan aggressive issuance. These are companies out there that issue high-yield bonds or issue bank loan debt. What are they using the raised proceeds towards? In the tech bubble, we had a lot of use of proceeds towards acquisitions, capital expenditures, more acquisitions there when it comes to bank loans, some leveraged buyouts, and this signified a pretty frothy environment back in 1999. This was how the housing bubble looked like in 2007. LBOs were much higher. Strategic acquisitions for bank loans was pretty high as well. Bank loan use of proceeds towards leveraged buyouts was extremely high at 41%. So between that time, all of these reds have come to a trough and have peaked up again. Red is what shows as frothy, and green is a benign sort of characteristic of those use of proceeds. Where are we now? Year to date, high yield use of proceeds have jumped up to 30%. We're above and beyond where we were during the tech bubble. Bank loan use of proceeds towards acquisitions is above and beyond the housing bubble. Leveraged buyouts at 25%, while not quite at the housing bubble, is already above the bank loan use of proceeds towards LBOs during the tech bubble. What does this tell us? We believe we're around the 8th inning in terms of the credit cycle, how close we are to that next market correction, but we may have extra innings depending on how slow the global economy grows. Here's another sign that we're at the 8th inning. This chart shows all the margin debt of all the New York Stock Exchange accounts aggregated together since when it started tracking this information. This was the tech bubble. This is the housing bubble. And this is where we are now. It's a little bit startling. Now, these are nominal numbers, so what we did was divide this, normalize this by market capitalization as well as trade volume. We saw exactly the same thing. The numbers we are at now are well above and beyond the tech and housing bubble, which tell us we're pretty close to that next market correction. So we've talked about the liquidity gap. We've talked about the 8th inning in the credit cycle. Let's combine those together. And in the next few slides, we'll take a look at how this illiquidity phenomenon will impact our portfolios. What's being done by the investment industry to try to cope with this problem? And what can we do as investors? So first, how does this bond illiquidity phenomenon impact us as fiduciaries? This chart plots the intraday trading range of the 10-year U.S. Treasury bond over time, and it's in basis points on a daily basis. What can we see? Prior to the 2008 financial crisis, there were smaller, more regular corrections. Since then, we've been getting large, irregular spikes. Another result we're seeing is the reduced liquidity has been eating away at alpha that managers can generate, the excess returns over their indices. At Marquette, we took a look at all 263 of the emerging markets debt strategies in the universe today, and all 221 of the high-yield debt strategies in the universe today. And we averaged out their annual excess returns over their indices pre-crisis and post-crisis. And what are we seeing? Alpha pre-08 crisis used to be higher, and alpha post-crisis is now slightly lower. Now, why is this? As part of my role, I meet with a lot of bond managers throughout the world. I have talked with the PIMCOs and Westerns on the West Coast, to Baird and Mesirow here in Chicago in the Midwest, as well as Loomis and BlackRock on the East Coast. And the messages I've been hearing are consistent. They're seeing wider bid-offer spreads. So for example, for high yield, what used to be quoted at 1% for a trade of a high yield block of bonds would be quoted at 1% and then ultimately executed at 0.5% on average. Today, when it's quoted at 1%, it ultimately gets executed still at 1% because the broker-dealer has to pass on the costs. Because of their lower inventories, they need to hunker down. Longer times. What used to take about 1 week to trade a block of bonds is now taking roughly 2 weeks, is sort of the median range that I've been hearing from managers. Sellers are seeing fewer buyers. Buyers are seeing fewer sellers. So now why is this? Why do we have this growing bond illiquidity problem? Dodd-Frank and the Volcker Rule here in the US, and Basel III out there in Europe. And so the joke is, the cumbersome regulations are so heavy, you've got to lift them up with a crane, as this cartoon shows. So I'm not going to go into the details of all the laws here, otherwise we'll be here for weeks. But suffice it to say that it's because these rules are requiring banks to hold more Tier 1 capital, cash, and therefore less inventory. They're also eliminating or have eliminated proprietary trading desks from various broker-dealers. And so we're seeing less and less liquidity in the markets because of these rules. So now, as fiduciaries, what must we watch out for? And not just during large market corrections. This is going to affect every single smaller dislocation, as we've seen last year with oil, earlier this year with Greece, and then China's devaluation. These are things that we and our boards should watch out for. This is concerning. The next market correction will be quite different than 2008. Back in 2008, we had much higher leverage. Leverage ratios on average were about 7 times debt to cash flow across the sea of corporate bond issuers. But back then there was a whole lot more liquidity. There were a lot more broker-dealers, a lot more inventory, so you had more liquidity. Today, leverage ratios are a lot lower. It's 3 to 4 times debt to cash flows, also due to Dodd-Frank, but the liquidity problem is very severe. There's a whole lot less liquidity. So things we should watch out for. Now, really quickly, I'll go through a few slides on what the investment industry is doing to try to solve this problem. First off, we have buy-side to buy-side e-trading platforms. This is where you have PIMCO trading with Goldman Sachs as a go-between, ultimately trading with BlackRock. That was the old days. Using one of these platforms, say Market Access, PIMCO would trade directly with BlackRock. They're both buy-side traders. Now, there are some problems here. First, the good news is for US Treasuries, we've been seeing nearly 100% adoption through one of the platforms called TradeWeb. But with investment-grade bonds, bank loans, high-yield bonds, emerging markets debt, it's still largely over the phone with a broker-dealer, or nowadays they use Bloomberg Chat with a broker-dealer, but it's still largely over a broker-dealer. Mostly sizes under a few $1 million of a block trade. And less than only 1/5 of investment-grade bond trading is via e-platforms. With emerging markets debt, it's pretty much zero. Now, why is this? Why is there such low adoption of electronic trading platforms for bonds? And that's because stocks and bonds are very different. As I'm sure many of you know, equities has been moving very much towards e-trading nowadays. NASDAQ, completely electronic. The NYSE is going towards an electronic platform as well. And why is that? It's because with stocks, there's only one type, one CUSIP of common shares. They're all the same. Whereas with bonds, you could have many types. For example, Verizon might have literally 40 different types of bonds, one for each different strategy, all with different maturities, different rates, and so on and so forth. Now, how does that cause a problem? You have investment managers that want to maintain their anonymity, but because there are so many tranches of bonds, maybe one tranche has 3 or even 2 managers that hold that entire tranche. It's easy when one of those managers wants to trade for the rest of the market to pick up, that was PIMCO that traded, or that was BlackRock that traded. So managers don't want to give up that information. Hence, they try to trade more privately over the phone with a broker-dealer. Another potential solution, exchange-traded funds. ETFs give managers easy access to a basket of bonds, especially when they want to ramp up new allocations for clients. And also, the good news is there's still a small portion of the overall markets. The overall ETF market is about $2 trillion today versus the overall entire global fixed income market, which is about $50 trillion. The bad news, they're flighty because ETFs are almost entirely held by retail investors that move in and out very quickly. And they're price takers. They have to sell off right away. And because there's so much in the news, the sell-off of ETFs could potentially drive market prices down in the next downturn. Another potential solution, credit derivatives. But there are problems here. So these are credit default swap indices. There's high tracking error. There's a holdings mismatch, and I won't go into the details here, but also a rate mismatch. What else are investment managers trying to do to solve, cope with, or circumvent this bond illiquidity problem? They could favor on-the-run bonds. These are the most recently issued set of bonds in the market today, which have more liquidity. All eyes are on them. But out of the entire universe of 5,500 investment-grade corporate bonds, typically only about 100 are on the run or most recently issued, while 5,400 are considered history. So that's not a great solution. They could standardize and consolidate issuances. This would be bringing Verizon's 40 bonds down to one bond. How likely is that to happen? Keep more cash, but if you have more cash in your portfolio, you're not earning much of an interest. And lobby regulators for repeal, and again, how likely is that to happen? So bottom line, the key takeaway here is we have a problem. Investment managers are, I think, doing as best as they can to try to resolve this problem, but they're not doing enough, which leads to the final point in my talk here. What can we do as fiduciaries? Firstly, diversify. We want to make sure we take advantage of non-correlating asset classes. Again, we're coming close to the end of the market cycle, 8th inning, pretty close to that market correction. We see that huge liquidity gap that's causing wider downdrafts, that's causing chipping away at alpha. Educate boards. It's very, very important for boards to understand this phenomenon, manage their expectations going forward. Take down risk. Avoid mandates that are too narrow. This would be if we have a mandate that might be limited in terms of maturity or rating. We don't want to restrict our managers so they don't have the flexibility. They could be stuck in a pocket that's too difficult to trade during a correction. Stay strategic. If you're too tactical, you're subject to a lot higher trading costs nowadays. Utilize active management. Index investing is really subject to the whims of the market. And finally, we want to make sure we know our managers, know their size relative to their peers. The larger size managers may get bigger client redemptions. They're more in the news. That could affect them negatively. We also want to assess their concentration in their portfolios.